Hello everyone. Welcome to my channel. On my channel from today onwards, we would be starting with some of the basics about the finance, and then we would be also starting on some of the playlist onto the personal financial management and stock market as well soon. But today, for today's session, we'll be starting with the basics of some finance concept that would be useful for everyone to understand the basic concept about the finance. So today we'll be learning a first concept about the finance as a capital. So most of the people might be hearing this term in their day-to-day management, that is the capital. So first of all, the we'll discuss that what is a capital. Capital, most of the people relate with the money, but it is not necessary that capital is always money. Money is kind of one of the capital for a company. So capital can be the kind of a thing, asset, equity, or stocks, or debt, which will help company to grow ahead, or the use that capital to invest further to grow into the market. So the capital is nothing but the company's kind of liquidity or the assets which would be used to earn money in market in future. So the next stuff is that how to generate capital. Capital can be generated by the promoters. Promoters are nothing but the individuals who started a company. They can bring in a capital. Capital can be initially money or some kind of the uh, loan borrowed from the banks, which will used for the benefit of the company. Then capital can be generated for the large institutions through the equities by IPOs. So IPOs would be get circulated or distributed by the investment banks. So we'll learn into the further sessions into the investment banking, that what are the services offer investment banks for the generation of the equities through IPO. Equity is nothing but the shares. So whenever someone is buying the shares, that money goes to the company, and that would be used as the capital. So there is another concept is a bonds. So through the bonds, companies can issue multiple bonds that can be bought by the investors, and that money can be used as the capital management. So when the company is doing such kind of uh, things or the decisions, it is always tricky to take a decision for the bigger companies. If they are investing billions of dollars into the market, it is not easy to predict about the profits or the things which they are going to get out of that into the future. So in capital management, next important concept is a time value of money. So as you know that today, if we are getting some thing into the $1, it might not be necessary that we'll get the same thing in future for $1, because the value of money will get decreasing in future as per the past. We can see that, because for example, if in a $1, if in 2000 we were getting the five chocolate, it is not necessary that in 2020 we'll get a same five chocolates in that $1. It might possible that there would be a depreciation of the money. So if the here we have taken the example, if the investor has invested 10 lakh rupees in some business, and after 5 years he is quoting that he is getting a profit of 12 lakh rupees. So is it profitable? That would be question for every investor. So here the concept would come into picture, that is a time value of money. And because the value of money would keep decreasing or keep changing according to the time in future. So it is not necessary that currently whatever the value of 10 lakh, it won't be a exact value of a 12 lakh. So the confusion is that how we can deal with that. So there are couple of formulas which we can use to determine that. One is very famous concept about it is a NPV, that is a net uh, present value. So net present value is calculated based on to the discounting rates. So for example, we'll consider that we have invested 10 lakh rupees today, and we'll be getting a 12 lakh rupees or more than that over a period of 4 year or 5 year. So each year, suppose we are getting equally 3 lakh in 4 years, so 12 lakh will be getting back. but we'll be considering the discounting rate along with it. So for example, our cash flow here is 3 lakh rupees. 1 plus R is nothing but a discounting rate. For example, current market rate is a 10% for lending money, or the market returning rate we can consider. So 1 plus point 10 is a 1.1, and I is nothing but the cash flow period. For example, 1 year. So the formula is that 3 lakh divided by 1.1 raised to 1 for first year. Then for second year, we can again do the summation, that is plus 3 lakh divided by 1.1 raised to 2, because it is second year, and we can do a summation of all 4 years and then divide by the initial investment. So we'll see it by the exact example. There are will there are number of ways to calculate NPV. So I will show you the simplest way, which you can do through the Excel sheet. So that is the easiest way for you to do. So first, let's say the example of this one, the initial investment, we can say, right? So initial investment the investor has done is a 10 lakh rupees, and then each year he is getting, first year he got a 1 lakh rupees, second he has got 2 lakh rupees, in third year he got 3 lakh rupees, and fourth year he got 4 lakh rupees. So he is getting a 10 lakh rupees after 4 year. So whatever he has invested, he is getting the back. But it is not necessary that according to time value of money, uh, theoretically we can, or logically we can consider that we invested 10 lakh and we got back a 10 lakh rupees. That means we are no in a no loss no profit situation, but that is not the case. So we'll tell you how to calculate that. So for example, here I will take an example. For example, first year, that is a 1 lakh rupees we are getting as per a formula. So 1 lakh rupees we are getting to us. So I have put it here, divided by 1 plus discounting rate is 10%. 10% means 10 divided by 100 is nothing but 0 0.1, right? So it is around coming as a this one, 90,909, and we have to use as a rest to thing, that is rest to 1. Okay, so it would be coming as 90,909. So similarly for second year we can calculate that. Like second year we got a 2 lakh rupees, so I have taken F4 divided by 1 plus 0 0.1, that is discounting rate. Okay, rest to 2. Okay, so you can see that 1,65,000 is coming. So first I have done with this formula, and then I simply dragged it. So it has taken the f this value of the cash flow, incoming cash flow, if you see here. So I have calculated for 4 year, and if I do the summation of this at the last, if I sum up this with the formula, you can see here the formula is coming as is equal to 7,54,000. That means you are getting a 10 lakh back, but its present value would be a 7,54,000. So how you will determine that whether you would be beneficial or not? So present value could be calculated according to this. So there is also one formula in Excel sheet that you can also use. It is equal to NPV. Okay, here, and along with NPV, you can give the discounting rate, that is 0.10. Okay, comma, and you can select all the fields for the years. Okay, and then you can get a same value, 7,54,000. Okay, and similarly I have used it here in this yellow bracket. So for calculating a net flow as per the formula, we have seen that the cash flow, it is a summation of the all the years for which we are getting cash flow. So we'll calculate a present value and we'll sum up that. For 4 years we have calculated that and we have sum up it, and then we'll div- subtract by the initial investment. So we are having the initial investment of 10 lakh rupees, so I have put it a negative. So it is the coming as 2,45,201. That means it is a negative one, and for from a negative value or positive value we can conclude that. So I'm going to the next one, that the in net present value. So this is how we are calculating a net present value. So by calculating a net present value, how the investor will determine that whether he's in profit or he's in a loss. So there are different concepts, that is a positive and NPV. So we'll go to the next example. So here you can see the example. I have taken I have invested a 10 lakh rupees. Then for example 4 year I am getting the returns out of that. First year I got a 3 lakh, second year I got a 3 lakh, third year 3 lakh, and fourth year 14 lakh. So return would be a 13 lakh total. Logically we'll see that we got a 13 lakh profit. So 13 lakh minus 10 lakh, we are in a 3 lakh profit, but value of 13 lakh might not be exactly same as a current value of 13 lakh. So we have again used the NPV formula. So I have calculated it here, and if you do the summation of that, the value of it would be coming as a 10 lakh 19,260 rupees. So again the calculating the NPV, so the current present value of cash flow minus the invested amount, it would be coming as a positive 19,260. So let's take example that I have invested a 5 lakh rupees, 10 lakh rupees. First year I got a 5 lakh as a return. The next year again I got a 5 lakh as a return, right? And then third year I got 1 lakh due to some problems in market, and then again I got a 2 lakh as a return, right? So still you can see that the 79,000 is a kind of positive value. Or if you are lucky, again third year you got a 5 lakh as a profit, that you can see that the NPV is a 3 lakh 80,000. That means it is a positive NPV. That means you would be in a profit in a business. So this is the example I have put it here with the Excel sheet, that would easy to understand what is the NPV and what is a positive NPV. Then we'll go to the negative NPV, as we have seen into the first example, minus 2 lakh 45,000. Though it is getting a 10 lakh rupees, but if we consider the market rate which you will get return onto the your money, it will be 10%. According to that, you will be in a loss of 2 lakh 45,000, though you do be getting a 10 lakh after 4 year. So in that case you can avoid the investment in such business. So the third concept is zero NPV. For example, the value which is coming here, if it come as a zero last NPV, that means it is the zero NPV. You are not in a profit, not in a loss. But that would be the rare condition with the formulas, because there would be positive or negative values, the chances are more. So in case of a zero NPV, obviously the investor or the who is doing the business would be always confused. So it is the investor's choice whether he has to go with that, or he has to stop his investment there itself. So this is on to the zero NPV. So this is for today. I'm just refreshing what we did. First we learn a capital. So what is a capital? So capital is a kind of money, equity, or debt through which we got investments for a business. It can be assets which will be returning you the uh, some of the benefits over the year. Then second is that how it can be generated. It can be get by the promoters or the other sources of the income into the business, or the equity, that is the shares or stocks. Third one is the debt fund. So companies, that is the reputed companies, can issue the bonds, and they can see the investor that will return you a fixed amount of money after some years, so you can invest in our business and we can plan something. So that is the third one. Then we have learned the time value of money. It is not necessary that whatever we are getting in a $1 we'll get it the same thing after 5 years. So need to calculate the time value of money, and how it would be calculated. There are different formulas like NPV, that is net present value, which we have seen. Then we have quickly seen that what is a positive NPV. In positive NPV, you can go ahead and do the business, or your investment would be fruitful. The negative NPV you should avoid if the NPV is negative, and then a zero NPV. NPV. It is a confusing thing, but still you can opt for it if you want to go ahead. So for NPV calculation, it is not necessary that you can go ahead with the uh, kind of the tools which I have shown you in the Excel sheet. There are a lot of tools in a market through which you can also calculate it. So there is kind of initial investment I have considered 10 lakh, and similarly I have considered as a 1 lakh, 2 lakh, 3 lakh, 4 lakh as a return. I have put a number of years, and you can see here the negative value is coming as well. So even on internet you can calculate it. It is not necessary that it is only for the large investors. Even which who are doing the kind of individual investors, or who is kind of doing the even the small thing. If you are buying some car, for example, and over the period of the few years, if you are getting the return of for example, the same value, then you have to calculate using NPV that whether it is benefit or not for you. So this example applies to the small businesses which you are doing. So this is on a NPV, what it is exactly, and on capital management. So for more videos, keep subscribing to my channel. I would be adding the more videos onto the financial management, and even on channel there are more of the technical videos if you are interested, and you can go with that as well. So thank you so much for your time. We'll see you again.